in this example, we are going to look at zero coupon bonds. The state of Ohio needs to raise $25 million for highway repairs. Officials are considering issuing zero coupon bonds which do not require periodic interest payments. The current market interest rate for the bonds is 8%. What face value of bonds must be issued to raise the needed funds? Assuming the bonds will be due in 30 years and compound annually, how would your answer, and then we're going to look at how the answer will change if the bonds are due in 50 years, and then also if the market interest rate were 6% instead of 8%. So the first thing we have to take into consideration is how zero coupon bonds work. These are also called discount bonds, and these are issued, but there's no periodic interest payments semi-annually or anything like that. But at the end of the time frame, whether it be 30 years or 50 years, those have to be paid back to the investors. So we want to figure out how much needs to be issued to allow the company to raise the funds and also be able to pay everybody back in the end. So we look at kind of how the equation works, and we're used to taking the face value of the bonds times the factor from the table and giving us present value. But in this situation, we want to know what the face value is. So we rearrange the equation a little bit, and the face value is going to equal the present value divided by the factor from the table based on 30 years or 50 years when we change it, and then either 8% or 6%. So in this example, we have 30 years at 8% zero coupon bonds, and it's compounded annually. So we rearrange the equation a little bit. We go to our table 1 because it's only at the end of 30 years. We're not paying out any payments, so we use the table 1. And the factor that we get with 30 years and 8% is going to be 0.099. So after we rearrange the equation and divide the 25 million divided by 0.099, we get about 253 million would be the amount of bonds we need to issue today in order to have the 25 million in the end of 30 years and be able to pay everybody back their bonds. Now if we change that to 50 years, we go to our table from period 1, or table 1, and we use 50 periods and 8%, and that says we need about 1.19 billion. And then if we go back to 30 years, but we use 6% market rate instead of 8%, our factor from table 1 will be 0.174 based on 50 periods and 6%, and we would need to issue approximately 144 million. 50 years at 6% from table 1, our rate would be, our factor would be 0.054, which would lead us to about, we need to issue 463 million.